After the recent RBI repo rate cut, how should investors rethink their allocation between equities, debt funds, and fixed deposits?
So see, any meaningful long-term wealth is created by through equity investments. Uh, s- Fixed income or FDs have a very specific role in our understanding. Is to either bring stability to the portfolio, because if your behavioral biases or your risk appetite is doesn't allow you to remain 100% invested in equities, then obviously these instruments can bring a lot of stability to a portfolio. Or also, like say, when equities are really overvalued, that is the time when you can take out some money from equity portfolios and go to fixed income or FD, right? Now, as repo rates have been cut, and the interest rate on the FD or on fixed income instruments will be lower, uh, obviously the return profile on the fixed income portfolio will go down, right? And that's a point when it is reminded that you need to have equity exposure, because let's say you were getting 6% after tax, even lower, that kind of a return profile will not help you even beat inflation, right? Now, in that scenario, there is an interesting play that is going on at this point, right? While fixed income or FD investors are worrying that, okay, I'm not going to capture these deals because interest rates are going to low. With any incremental money that is going to come in from me, will basically now be invested at a lower FD rates, right? While on the other hand, if you look at equity investors, they are happy. They are looking at lower interest rate environment, low inflation. Now consumption will boost. There will be new fresh capital investments because the hurdle rates have come down. On the same side, when the risk free rate, which is linked to the inflation number and the repo rate or the 10-year G-Sec yield, that is also, when it is reducing the hurdle rate for the long dated cash flows, which is, like say, equity is a long dated cash flow instrument. Now there, with a lower hurdle rate, obviously the valuation goes up, right? So there is a double benefit on the equity investment side. The market activity, the economic activity is going up. The fundamental value, in terms of however you calculate, because the hurdle rates are going down, that is going up. So it's a very good thing for equity investors. It's not so good thing for fixed income. So you have to, uh, you know, as a long term investor, whether you are a conservative investor or a very aggressive investor, uh, we always believe that you need to have a very very meaningful allocation to equities.